Hello and welcome to this week's special presentation. My name is Jim Penna. I'm the Manager of Retirement Services here at VectorVest, and I'm very happy to be hosting this week's topic, which is titled The Inside Story of Relative Safety. If I go to the Views tab and pull up Dr. DeLito's essay from last Friday on February the 15th, Dr. D talked about his entry into the all-subscriber portfolio competition, and he talked about how the rabbit got stewed, but high relative safety stocks live on. He went on to mention that though they did not perform very well during that mayhem that we saw from early October right through Christmas Eve of last year, that high relative safety stocks have performed very well since the market bottomed in late December. And for example, Dr. DeLito ran a few quick tests each Friday on the top high RS stocks since that Friday after Christmas Eve. And here are some of the results. What I'd like to do right now, I'm going to go into the Unisearch tool. I'm not going to run a whole bunch of back tests, but I am going to go into the Prudent folder and look at one of our favorite high relative safety searches called Ruler Stocks. And I'm going to run that search to that Friday after Christmas Eve. We'll see the top stocks that are returned from that search. And the key parameter here is that relative safety indicator, which is on a 0 to 2 scale, has to be greater than or equal to 1.4 just to make the list. That's considered excellent in the VectorVest program. So when I run the search on the 28th, I can go quick test the top 10 stocks from that search, and we can see how they've rebounded since that December low. We've got all winning trades in just about a month's time. We're up just about 21%, 136% annualized out, and it has performed significantly better than the S&P 500 over that same period. And so just one quick illustration on how resilient high relative safety stocks can be. And so to go along with that concept, tonight I wanted to dig deeper into the inside story on relative safety. Relative safety in the VectorVest program is an indicator of risk. We say that the consistency and predictability of financial performance are the primary factors in assessing relative safety. Consistent and predictable financial performance. I find it hard to find two better adjectives than consistent and predictable to define the type of stocks that are in your portfolio. I want to take some time tonight and dig deeper into the factors that we reference in that definition. We talk about earnings consistency, company size, price behavior, the longevity of the company, dividend history, and debt to equity ratio. This is our safety checklist. I want to begin with earnings consistency. Now, the largest risk that shareholders have is that the company fails to meet earnings expectations. Experienced investors know that the moment of truth comes every quarter when a company you may own is about to announce its earnings for the quarter. Now, if a company fails to meet analysts' forecasts, the stock often drops significantly in a single day. Therefore, the single most important factor in assessing a stock's safety lies in quantifying the probability that quarterly earnings will meet investor expectations. So if a company has a well-established record of consistent and predictable earnings, performance is much more likely to meet those expectations. And that's what we see here in the Visa graph that we're looking at, that lower left to upper right movement of price. And then down below we have the earnings per share. In the VectorVest program, remember, it is a combination of historical and forecasted earnings that we use to look ahead at the earnings projections, and we see that earnings per share are very strong for Visa. And so that's the first box we want to check off on our safety checklist. Next is company size. It is true that stocks of larger companies generally are safer than those of smaller companies. So if we look at some examples, we have Nike, United Healthcare, Visa, the graph I just showed. You also have Disney. Now these are larger companies and they tend to be safer than smaller companies. However, investors should not assume that shares of a company are safe just because they belong to a bigger company. You must keep in mind that size is not nearly as important to an equity investor as knowing where the company's earnings are heading. And GE is the best example. So on that 0 to 2 scale, we see these large companies with very strong, excellent relative safety ratings, where GE, also a large company, right now is struggling, as we know. Size does matter, but earnings, again, are more important. And so we'll check company size off of our stock safety checklist. Let's take a look at price behavior. When we're looking for high quality, high relative safety stocks, we want to look for stocks that have very little price volatility and that don't have these violent drawdowns like we see here. So when we compare price behavior of a stock like CLVS versus a stock like Visa, we're looking for that smooth, steady price pattern in price behavior. And so along with earnings consistency and company size, price behavior is a very important factor when we're assessing the safety of a stock. Next is the business longevity. Here's an example of a stock that's been around for less than a year. Doesn't mean the stock can't grow to be a safe, quality company, but as Dr. DeLito has written, it's better to deal with the devil you know than the one that you don't. So all other factors being equal, there is less risk dealing with a company with a longer track record than one that's brand new. So young companies can offer some of the best opportunities, but they also bear potential pitfalls. So regardless of how good a stock looks, we want stocks with a longer track record. And so we'll check business longevity off of our safety checklist. Next is dividend history, and this is an important one, especially when you're looking to build and manage your retirement portfolios. Now, a company doesn't have to pay a dividend to have a very safe stock, but if it does pay a dividend, it must maintain, or more importantly, increase that dividend without exception. A cut in the dividend or failure to grow that dividend is a black eye for any company, and it reflects poorly on the stock's safety because it calls into question the stock's ability to continue to grow and consistently make money quarter over quarter and year after year. And so dividend history is a very important factor that goes into stock safety. So we'll check dividend history off of our checklist. And then finally we have debt to equity ratio. Now this is just basic balance sheet logic here. Debt to equity is a measure of a company's financial leverage. It shows what proportion of equity and debt the company is using to finance its assets. And really what it comes down to, if that ratio between the debt and equity is unfavorable, if a company is carrying too much debt, then there is an opportunity that if there are headwinds specifically for the company or in the economy overall, will that company have the ability to withstand those headwinds? And debt to equity ratio is a great way to determine that. So that's factor number 6. So when we talk about relative safety, the inside story there, we believe, goes far deeper than just saying they're consistent and predictable. So I wanted you to know exactly what goes in to the funnel that gives us that RS, or that relative safety indicator, in the VectorVest program. And that's very important because when we focus on stocks like high RS stocks, if we build a portfolio, now this is about a 10-year portfolio here, using our long-term winners RS descending investment plan, and you can see over time the high RS stocks are going to be resilient. There will be drawdowns, of course, like there was in October, but here we have a portfolio with a very basic trading plan that has netted just about 25% annualized rate of return over the past 10 years. So this is the importance of high relative safety when building your portfolio for the long term. Now, with all that in mind, what I'd like to do is go back into the program, and I'm going to click on the Graphs tab. And I'm going to bring up 2 stocks. The first stock I'm going to bring up is JKHY, or Jack Henry. I'm also going to take a look and compare that to another stock called Ross Stores. And when I click on Graphs, what I have here is a graph set up for 2 stocks, JKHY and Ross Stores. And I want to compare the two because this is important. After speaking with Dr. DeLito this week, we talked about high relative safety, and he had commented on high RS stocks are resilient and they do live on, but there comes a time when it is okay to cut ties with a high RS stock. It's not meant to buy and hold forever. We have to keep an eye on the movement of earnings. Earnings is the key to everything, to driving the individual stock, which drives the overall market. And so here's a good example. If we look at JKHY, which was a high, and still is, a high relative safety stock, that if we owned right up until that peak here in October where the market turned over, and if I drag this out, we'll see that JKHY was a good performing stock. What happened was the October 4th downturn began. While earnings were still rising here on the lower graph for earnings per share, we see a couple of things that stand out on the graph. First of all, we did get the confirmed down call on October 4th. We then saw relative timing, the RT indicator, it had peaked earlier and begin to trend downward on the stock as the stock began to move sideways. Now this is all fine. If you own the stock in a longer term portfolio, the idea here would be to go out and protect the stock, right? It would be time to be proactive because the Market conditions had begun to change. Because RT was falling, there were a lot of reasons to be defensive on these good quality stocks that you own. And that protection would have helped up to a point. So what happened was JKHY then garnered a hold rating along with RT heading down towards that one line, which it ultimately crossed below on November the 7th. So this would have been a great time to protect the individual stock with either a protective put, or what we like to use is the collar trade, where we sell a covered call and buy the protective put. That would be your first call to action here. However, not too much later, the company announced earnings, and that didn't go so well. So what happened was the forecast, and you can see the dramatic drop in earnings per share here on the subgraph, and what that illustrates is a fundamental change in the forecast of earnings for JKHY, for Jack Henry. So the point being, we don't have to hold on to the stock just because it's a high RS stock and hold it forever. We can begin, as that company begins to flatten out and turn over, we can begin to protect it. But there comes a point when RT is down below 1, when the stock became a sell rating, when we see the forecasted earnings break as we did here, it's time to move on. There are other really good quality high RS stocks. It's not to say Jack Henry is going to crash here. I'm not advocating going out and shorting the stock. I'm talking about the aspect of a long-term portfolio and the quality stocks we want to keep based on high relative safety. Now I compare it with Ross Stores here because what we see is also a stock that began to move sideways and turn down during that October to December sell-off. And what we also have is a stock that hit a sell rating. So what's the difference here between Jack Henry and Ross Stores? Well, clearly it's the earnings per share graph here. Earnings per share, while it did have a report that the market took issue with, and it gapped down on earnings, it kind of moved sideways, but when the market began to rise again, so too did Ross Stores. So this would have been a great example of where you could have protected this particular stock, as opposed to selling it because the earnings per share had broken down on us. So with that, what I'd like to do now is walk through a process I've walked through several times on different special presentations, but I believe it is so important that those who are building and managing and protecting their retirement portfolio, this process is a trade that I don't believe is a luxury to understand or want to perform in your portfolio on individual stocks. I believe it's a necessity. If you're going to preserve your hard-earned retirement nest egg, the following steps and the following trade is a tool that you should have in your toolbox to be able to protect and defend your portfolio. So I want to walk through that process once again here. And this is a recent example on Ross Stores, one of my very favorite stocks in our entire database, a very high RS stock. And here's the scenario I'd like to set up. It's a case study. On June the 6th of 2018, we purchased 100 shares of Ross Stores at $84.06. That was part of a worry-free investing portfolio from our Ultimate Retirement Solution coaching group that we have every Tuesday. So we own the stock. We bought it during a confirmed up. It filled a spot in our portfolio, and it did exactly what we wanted it to do. It rose in price and set us up with a very nice unrealized gain. On November the 12th, Ross Stores traded as high as 103.77, which at that point had left us with a 23% gain on our position. Okay, so that's our scenario so far. Now, because we do our due diligence on all of the positions that we own, we know that earnings were about to be announced a week later on November the 20th before the bell. It's time to act. We want you to be proactive, to take proactive measures to protect your overall portfolio or the individual stocks. So what we went out and did was place a collar trade. Remember, we bought the stock back in June, way down around $84 a share. The collar trade consists of these steps. With Ross Stores now trading at 101.77, we simply went out and sold one December 105 call option. We used the premium received from that call option, and we bought an insurance policy. In other words, a put option, a December 100 put on Ross Stores to protect us if the stock were to gap down because of earnings. Now I want to be clear again for those who may not be familiar or actively trade options. This is not designed to turn you into an options trader. You do not need an entire options education to be able to understand and implement the two most very basic option trades there are, which is the covered call and simply buying a put option for protection of either your overall portfolio or for an individual stock. I'll say again, I believe it's a necessity if you are managing your own retirement nest egg. So keep that in mind as we go through. So we place those trades, and here's the result of our case study. So with raw stores trading at 101.77 on November the 12th, we sold that December 105 strike, and we took in $2.90 per share. So for one contract, that's $290, as each contract represents 100 shares. That's step one to setting up the collar trade. The second step is using that income to buy your insurance policy. And here's the key. What protects you is the put option. One December 100 strike put option that would cost us $3.55 per share. So what's the outcome of that? What we were able to do is pay $3.55 for the put. So if we hadn't sold call option, we would have paid $355 for our insurance policy. Instead, we used the $2.90 call premium we received and ultimately paid only 65 cents per share. Right? That's $65 to insure at that point a $10,000 position. So that's the setup of the collar trade. It's simply the simultaneous sell of a call and the purchase of a put option. So let's go ahead and see how this played out. Again, on November 20th, Ross Stores announced earnings before the bell. And what happened is the stock gapped down, and it closed at 82.64 on November 20th. What just happened? Let's take a look on a screenshot from one of our option analyzing tools here. What would have happened had you done nothing, right? Remember, we set up the collar trade. Had you done nothing, remember, we bought the stock at 84.06. The stock traded as high as 103 and change. If we had done nothing, the stock moved all the way back down to 82.64, and we would have an overall loss on our position of $142. Now, that's not the worst case scenario in the world, losing $142, but I don't look at it that way. We bought it at 84.06 and it was trading above 103. I own it at 103 in my mind. So we could have mitigated that loss tremendously, but if we had done nothing, we lost $142. But because we were proactive, close of trading, that day earnings came out, the put option that we purchased was now worth $17.28. Remember, we bought it at $3.55. Just one contract is now worth over $1,300. The covered call that we sold for $2.90, because the stock fell, the value of that call option did as well. And so we also made $285 on the call option that we sold. So when a stock falls, if you own a put option, the value of that put rises. So we were able to profit from the option portion of the trade for over $1,600. Now, how did that affect the overall position? Here in the upper left-hand corner, you'll see the debit from our account, or in other words, the cost basis for our 100 shares of Ross Stores. It's now $8,471, or $84.71 per share. That's up from our original purchase price, and it's up because remember, we paid 65 cents per share, so we adjust that up to $84.71 per share. But that's a small price to pay, because what happened is, when we add on that net profit, it gives us our position value of now $99.87. That's a gain of just about 18% from that adjusted cost basis. So instead of actually losing money, we were able to profit, and we're able to hold on to the stock, because remember, when we go back and look at the graph, the stock was resilient and did pull back from that low. It gave us the option to hold on to the stock because we didn't have to suffer through that drawdown that came from that earnings report. So if you're interested in learning more about the collar trade and building a portfolio of high relative safety stocks, I just want to take a moment and introduce you to the new Ultimate Retirement Solution online course that we have starting next week. We want you to be able to protect and grow your retirement nest egg so that you can retire with the peace of mind that you deserve. I'd like to just take a moment and walk through the roadmap of our Ultimate Retirement Solution course and lay down the foundation for each module. We start with win before you begin. We believe that building and managing your retirement portfolio begins with defining your objectives and having a vision. So we'll walk through all of the things you need to do to prepare for retirement. In Module 2, we'll talk about finding the right stocks at the right time, how to recognize, how to very easily in the VectorVest program find those high RS stocks so that you can build a portfolio of high quality safe stocks. We'll also talk about setting up the plan as far as exit strategies and investment strategies go, and how to allocate and balance your portfolio. That's the capital appreciation or the growth side. In Module 3, we'll do the same thing with a dividend portfolio. We'll walk through the same steps to help you identify the highest quality dividend-paying stocks that you can find, and how to build select strategies and set up your plan for a dividend-paying portfolio. A lot of folks will just go out and chase the highest yields thinking that those are the highest quality dividend stocks, but it's just not the case. There's a lot more that goes into a high quality dividend portfolio. In Module 4, we will walk through creating your income stream. So we'll take the dividend income a step further and talk about generating income using covered calls. So here's where, if you're not familiar with call options and covered calls specifically, I will walk you through a step-by-step process so that you have all of the tools you need to be able to take advantage of selling covered calls and generating income on stocks that you own in your portfolio. In Module 5, we'll talk about the strategic defense system. And here it's all about the protective put, or the insurance policy that you can place on your overall portfolio or on individual stocks. We'll also delve into the collar trade that I just showed the example of, so that you can not only know what tools to use, what trades to use to protect your portfolio, but those strategic times where you need to recognize when that defense is necessary. And then finally, we'll help you implement your plan. All of the education and the theoretical aspects of this is great and it's very useful, but it's really not going to help you if you don't have a plan to implement. And we want to walk you through the allocation of funds, how to actually build the portfolios, and supply you with trading checklists that are going to help you follow that specific plan. So all of that's going to be available to you with some added bonuses. If you sign up for the Ultimate Retirement Solution online course, we're going to give you 6 live mastery sessions. So we have live modules, the actual lessons, and then each week, later in the week, we're going to have a mastery support session so that we can specifically go over what we learned in the module and answer any and all questions that you have, help you implement what you've learned. And don't worry if you can't make it, all of these sessions are recorded and archived for your access. Another great bonus that we're going to offer for the course is 6 weeks access to our Ultimate Retirement Solution Retirement Group Coaching class. Every Tuesday at 2 p.m. Eastern Time, I host a retirement webcast that goes through weekly retirement portfolios that we manage here in Retirement Services. We'll also go through, for what we call our retirement income portfolio, a weekly covered call trade that we place each week that helps us, again, generate a nice, steady, safe cash flow in our portfolios. After the course is over, if you show that you've done the work, that you've come to the classes, and you find that you're still not satisfied, just know that we will give you a full refund. We will happily refund 100% of your investment here. It's what I like to call the truly risk-free trade here. So you can go to VectorVest.com/URS to sign up for the course. The pricing is as follows. The Ultimate Retirement Solution regular price is $9.95. We've got an early bird price of just $6.95. You can sign up and save $300. That price, however, will increase Monday, February 25th at 5 p.m. Eastern Time. Now, if you're an Elite member, you get the Elite price, which is half off the regular price. To do that, you won't be able to do it through the link that I'm showing here, but you will need to call our product support floor at 888-658-7638. If you go to VectorVest.com/URS, you will see this registration page here. When you click on register, simply fill out the pertinent information and go ahead and hit register. You do not need a discount code. Just make sure the early bird is checked. Just a quick calendar. The course does begin next Wednesday. This is actually February 27th at 4:30 Eastern Time. Each of the next 5 Wednesdays following, we will be live 4:30 each Wednesday Eastern Time. Again, they will all be recorded for your access in digital chalk. And then each Monday, the following Monday, we will have our mastery session, which will be live at noon. Market will be open so we can go through any scenarios or circumstances that are going on in the market. These are also recorded in case you can't make the live session. So again, the price will increase on Monday, February 25th. The early bird price is $695. Go to www.vectorvest.com/URS if you're interested in learning more about building and managing your retirement portfolio. Elite members, please give product support a call for that $497.50 pricing. And so thank you for taking the time to join me for this week's special presentation. As always, if there's anything we can do to be of assistance, please don't hesitate to call our product support floor at 888-658-7638.